Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Vinay Joseph. I'm Director and Head of Investment Products and Strategies at Standard Chartered Bank. In continuation of our series on podcasts regarding our H2 outlook gradually shifting preferences, today we discuss how do we see the macro environment evolving over the second half of this year. Now this is a very critical question as 2022 is a mid-cycle year similar to 2004 and 2011, and the macro environment in the second half of 2022 will determine if this mid-cycle transition is successful like in 2004, where markets recovered after the initial fall to hit a new all-time high over the next 6 months, or is it unsuccessful like in 2011 with equity markets entering a 3-year-long bear phase? Now from growth, we expect India's economic growth to remain above its long-term trend in the coming year amid a low base, broad-based economic recovery and a revival in consumption and private capex. High-frequency indicators like PMI, IIP, auto sales, electricity demand, GST collections all continue to register double-digit growth and pointing to a very strong economic growth environment. However, inflation continues to trend higher, and we view CPI inflation is likely to stay above 6% for the entire fiscal year 2023, given the pass-through of elevated commodity prices, persistent supply issues, and also very strong pent-up demand. Now moving to policy. In our assessment, fiscal policy will take over the mantle from monetary policy in the coming year. The government's focus remains on boosting India's medium-term growth outlook through first, greater public capex spend as highlighted in the budget, 2, undertaking long-standing reforms relating to taxation and labor, and 3, providing incentives to boost manufacturing and infrastructure spending. As highlighted earlier, the defining characteristics of a mid-cycle is the withdrawal of monetary stimulus. Now in this year, YTD, or in the first half of 2022, the US Fed and RBI has raised policy rates by 175 bips and 90 bips respectively to curb record high inflation. Going ahead, we expect the RBI to hike policy rate by at least an additional 100 bips in FY 2023, given persistent inflationary pressures and above-trend economic growth. Faster rate hikes by the RBI and US Fed is likely to pressurize interest rates and bond yields further in the coming year. So overall, we expect India's GDP growth to remain above trend and ahead of its major peers for the fiscal year 2023. This is very similar to what we saw during the 2004 mid-cycle. However, inflation and bond yields are significantly higher compared to 2004, indicating the possibility of more tightening down the line. Nevertheless, the terminal policy repo rate is likely to be lower compared to 2011 as inflation and bond yields are still trading and are likely to trade lower than those levels. So overall, this indicates that the macro environment still remains conducive for risk assets. That's all for today. Please reach out to your relationship manager for a copy of our report and watch out for this series of podcasts on our H2 Outlook. As always, if you find this podcast useful, like and subscribe. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.